Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Daniel Wachs with Perpetual Wealth Management, and we'll be talking about navigating the complexities and fears of premium finance. Daniel, welcome to the program.
Mike, it's good to be with you again. I'm looking forward to going over these topics with you today. So, navigating complexities and fears of premium financing. Great topic. Let's get started.
Yeah, we kind of, in our previous conversation, chatted about, kind of foundational, what it is and what to expect. Well, now it's kind of like, let's roll up our sleeves and we're starting to dive in and we're starting to structure some things. I'm confident, like we've mentioned before, that this is this is not something you just decide to do one day, Google it, set it up, or even meet with a professional and go, let's set it up. This takes some time and thought and strategy. And because of that, sometimes there's fears. Sometimes people go, well, if it takes more than a minute or two to set up, then, is it too good to be true? Or what if it doesn't work? So talk to us a little bit about what are some of those common fears that people have regarding this kind of a program.
I think the main, if I think through your question, what are the people's fears? I mean, I think the fear is also related to what are the risks of the strategy? So I want to start there and just say, here's the risk and here's what we try to mitigate through. So, the main risks that come to my mind whenever you're, borrowing funds to pay the premiums is, of course, interest rates. If our interest rate cycles go up, they go down. We've seen, ultimately interest rates near zero, years back, and then the Fed raises rates 13 times in a couple years. So, those are, real and fears. So when we design plans, we have to be able to be flexible, to work through those different strategies. So one of the fears is, what are interest rates gonna do? And the good news is that, interest rates have been coming back into lowering because the inflation numbers are finally getting under control. So interest rate is one. The second would be the policy that you're using for the financing. Like we talked a little bit in our last episode is we have to have arbitrage. We're going to borrow money at a certain rate, and we need the policy long term to perform better than what we're borrowing money at. So that arbitrage is super important. So we have interest rate risk, we have policy performance, and then in this strategy, Mike, that in the early years of the transaction, the cash surrender value is never going to be dollar for dollar of the money going into the policy because of the death benefit and the insurance costs and all, that. And in the early years of an insurance product is, the expenses are higher because, if something happens to a client, and I've dealt with this where they make a couple payments and, and I had a client that got into a car accident and passed away, unfortunately. Great guy. But he made two payments of like a couple $100,000 for each payment. And all of a sudden, the death benefit arrives, the bank loan gets paid back, and his family has, $20 million that is protecting it. So the need for insurance is always part of the strategy, but that's why people buy life insurance. It's, all these other things that we're talking about are ways to fund it. But the bottom line is his family was protected in an unfortunate situation that happened. But that is, in those early years, then, because that surrender charge is in the policy, then a client will have to post like an outside source to provide collateral, so the policy is always going to be the main source of collateral, but then that outside collateral is going to secure the loan. Because the one thing in this world that clients need to understand is that the lenders, love this strategy. Because if a client dies, they get paid back. They have it protected. If he lives, they have to post collateral. So as long as the bank is secured 100%, whatever they've borrowed, they need it secured by the policy and outside collateral. And usually, fifth or sixth year, that outside collateral is not needed anymore. But so we have to have clients that are willing, in the transaction on the front end, to know that, yeah, there's going to be some collateral post. And I kind of give it an example, Mike, of when we buy a property or we buy a house, the common thought is, I need to put at least 20% down, to get a mortgage on the rest of the money needed to buy the property. It's similar in this situation that 20% is not really being put down or given to the bank, but it's put on the sidelines, to protect the bank's interest in lending the premiums for the client, to the insurance company. So that's a risk, that people have to understand. And, as if the policy doesn't perform like expected or like an illustrated, then, that collateral number can, be increased, but it's also decreased as the policy grows. So we got,
just hearing through a few of your points there makes me think from a consumer standpoint, one of the fears could be there's so many moving pieces and it's so complex. What if I'm embarrassed if I tell someone what I'm doing and I don't even know how to explain it, and they certainly don't understand it, and then they challenge the whole strategy and now I'm second guessing it and I feel embarrassed? How do you help educate your clients so that they are got to have a firm grasp on the benefits so that that doesn't come up?
Well, I think it's inevitable that it's going to come up, Mike. I mean, I've been doing this a long time, and I think that the client, they understand lending. I mean, so that's that part they get, right? I mean, they understand I'm borrowing money now, what we're going to pay and the interest rates and all that. I mean, that's always going to be something that could be on their mind to do. But also, they have to, get to understand the products. I mean, so, being in this business for such a long time, I've seen a lot of different products, and there's term insurance, there's universal life, there's, index universal life, there's variable life, there's whole life. What product makes the most sense for this strategy? So that's what we have to figure out. Is this client wired towards guarantees? They need guarantees. Then they're probably going to lean towards a whole life policy, right? But when you have guarantees, they're also expensive. And the fact is that, and the guaranteed whole life product is, there's not a lot of flexibility in regard to, taking a detour or changing course if life happens and we need to change course. So there's not a lot of flexibility, with the payments and in the premiums. So, but I mean, the thing that I like I said in the strategy is, you educate, and depending on the structure, then, knowing and studying and learning, I mean, you have to be able to provide a solution for the client, but then give them the reasons why. And what I found in this relationship, Mike, when you asked about like embarrassed or other things, I really feel if you tell people the truth, especially high net worth people, I mean, you tell them the truth. Don't try to make up stories, and it's uncomfortable, but it's real, right? I mean, and life happens, right? Like we were projecting to make this payment, but something happened in this business, so we have to be able to figure out and maneuver and maybe not make a payment this year and work with the bank. So these are all the things I think the specialist brings to the table, and it's relationships, right? I mean, so I mean, I feel like, if you treat other people like you want to be treated, I mean, that's kind of the golden rule, and it's a golden rule for a reason.
That's a excellent point. I love how you're like, oh, well, that's not going to happen because It probably will happen. And
Yeah.
if and when it does, here's what you do about it. And that's just very, very sane. So let's talk about a little bit deeper about, you mentioned this in passing, but some of the performance. How do interest rates that could go up impact this strategy? Because I know that years ago in the late 90s and early 2000s, I was in the mortgage industry, and I know that you can get a very adjustable interest rate. You can get a home equity line of credit for a house. You can get a fixed rate. Sometimes the fixed rates cost more money. Well, in this world where you're talking about, the interest rates could go up. What does that do to the projections that you are working with?
Well, I think it's really important to understand the interest rate impact. Now, of course, when interest rates go up, that means that the cost to borrow money is going to be more expensive. That's a
Mm-hmm.
given. So, I mean, we do have banks that offer, 1 year terms, adjustable rates. That's the most common strategy. But there's also, fixed pricing, 3, 5, 7, 10 year fixed pricing. And similar to mortgages like you were in, Mike, is that same for me, is that if a bank's rates are not competitive, I mean, I have to be able to go to other lenders and say, this is the structure of the deal. And the good thing, the nice thing about as the policy receives its premiums over time, that as that loan balance gets bigger, usually the spreads on the money and everything can be lessen, I mean, be lower. And I do that on a regular basis. I mean, I ask the banks, can we reduce the rate for this client? Every little bit helps, because the ultimate goal is that we're going to probably make 10 payments to this policy and roughly hold the loan for about 12 or 13 years is what I feel, allows the policy to grow enough to be able to, pay the bank back. Now, when rates got super high, what we did, Mike, and one of the strategies we did is take, a loan internally on the policy, because a lot of the policies that offer, loans, have guaranteed rates. So like if money's costing 7%, the loan inside the policy guaranteed at 5, we may pay the bank back early and then have the client pay into the policy. So knowing how policies work, knowing how banks work, I mean, and then, life happens and we have to be creative and figure out, how do we make this work for the consumer we're dealing with.
Yeah. Yeah, it's always like, let's wake up today and see what challenges have presented themselves, and then let's see what we need to do about it. Life rarely is so dialed in that it's the same thing day after day after day. So I think that's a great point. Is you just adapt. You just adjust and adapt, and interest rates might go up, they might go down, they might stay the same. But if the projections that you put into place on the front end were very relevant and sane, they shouldn't be through the roof anyway. As far as over promising, they should be pretty dialed in, so that if rates did go up, it's not going to be that much off. If rates go down, then you're going to get better projections. So it's all about the expectations.
Yeah, and I think that in regard to the rates too, like when rates increase. What I don't think people realize is that, that allows banks, insurance companies, to get more yield. And what that allows in some of the products that we use on the indexing side is for the caps, the participation, and all those to increase. So maybe paying more, but, if done properly, a client could actually earn more as well. So it kind of offsets the low interest rate, low payment, and less performance in the policies, because, the insurance companies are struggling, to get yield on their investment. So I think it works hand in hand.
Yeah. Yeah. Very, very good. Hey, so let's think about this. What should some of the maybe performance metrics be that clients should be looking for in a policy to make sure that these financial goals are met?
Well, I think that, is when you have, a debt on a policy, you have to have a policy that, has the ability to perform. It doesn't have to perform every year. We want it to perform every year, but it doesn't. But being able to outperform, what I'm borrowing money at is critical. That's why, a lot of whole life type policies, the interest rate environment is kind of going to dictate the dividend of the insurance carrier. So, when I was at Northwestern Mutual back in the 90s, I mean, the dividend rate was like 8.5%, right? And then it got to like under 5 when rates were so low, right? So it was working the same as interest rates, where some of these indexing products that we use now, that can link to different markets, are fantastic, that they can, really grow. And if we're linking our returns to those indexes, the beauty is that we're not right all the time. So if an index is negative, it has a bad year, the stock market is down, like in 2008 and 9, the market lost 50%, right? I mean, so none of our clients lost any money in these strategies based on what happened in the market. And then we had a 10-year period of time of just riding a market that, just kept going up and up and up. And it was so, that's where you just have to be in tune, with what's happening, in tune with, what strategies inside the policies give us the best shot to earn money. And that's, that might be this strategy this year, and it's going to be maybe a different strategy next year. So having an annual review and reviewing all the choices is I think probably the most critical part of this strategy.
That's a great point. And like, if you have that review in every year, but if, let's say, then year 2 or 3, you say, you know what, we need to make some adjustments. That does not mean that our original plan was off base. It just means that external circumstances might have changed, like inflation or interest rates or whatever the case is. So that is really, really powerful. You don't just set it and forget it. You got to make sure you're doing your annual review.
Yeah, this is not a set it and forget it strategy. I mean, that's just not the way this is going to work. And so, with the different strategies that we choose to, is like the nice thing, Mike, is that, like, if let's say a strategy we choose really, it doesn't work for the year. And the nice thing about insurance is that, every year the bank's putting in another premium. So, if I got a 10% rate of return on my in my first year, which is great, let's say that the bank put in $500,000 for the client, and they made 50 grand. That's great. But after year 10, now the bank's put in 500,000 for 10 years. Now you got 5 million in the policy in year 10, and you get a 10%. You just made 500,000, right? I mean, so you can make up a lot of early year underperformance, maybe, with having a really good performance. That's why you got to monitor and really shoot for getting back on track, and that can be done. It's just that the client has to have resilience, and just like anything else, I mean, this is not a strategy that works in 1 year, 2 years. This is a long-term commitment.
Yeah. 100%. You had mentioned in our conversation just a few minutes ago something that I want to go just a little bit deeper on, because you mentioned collateral. And I know that, any bank out there, like, hey, give me a whole bunch of money and I'm just going to sign my name to it. They need to have collateral. Well, they have the insurance policy for that, but also they might need some external collateral. Is there a benefit to both sides of the equation? So how can getting these loans with collateral be managed to minimize risk and maximize benefits for the client side? Because I know that minimizing risk and maximizing benefits is on the lender side, because the lenders write the big old check. They want to make sure that their name is on a couple different places in case you default. Are there some ways to maximize benefits from the client side?
Yeah. So the different ways that people can post collateral is the following. Some people, are maybe they just have a lot of cash in the bank, right? I'm not talking about, the bank because I want to be specific is that the banks that provide the financing for insurance policies are separate divisions, very specialized lending. And it's not like you go down to your corner bank and
Yeah.
the teller knows what premium financing is, right? I
Right.
mean, this is specific. I work with departments and banks that all they do is finance policies for high net worth people. Now,
Mhm.
so we may need, I have a client that have cash and we may use some of their cash in CDs or money markets and put, and the bank will put an assignment on that and use that as the outside external collateral. Some clients will issue and open up a CD with the lender and just use that as collateral, with the lender we're using. Other people, may have investment portfolios, and it doesn't change, how the portfolio has to be managed, because on the front end, the credit team from the bank that I work with will look at the portfolio and say, okay, we're willing to give you, 70% value of this, as the number we need. So if I'm using an investment portfolio, it's never going to be 100% because of market risk, right? It can go up and down. So
Mhm.
they have to put a cushion in there. But the advice, see, I work with a lot of financial advisors, Mike, and I don't want them to have to, you know, move assets to the bank, because some banks require that, and I tend to shy away from that, because I don't want to take money from my clients and I'm working with as advisors. But if they know the formula, like if they get X for bonds, X for stocks, and they know what it is, then what we do is usually set up a separate account with what we need. So if a client needs to have 300,000, we'll do a separate account. So we're not tying up. If they have $1 million portfolio, I only need 300, but the banks put an assignment on the account number, which would then tie up all million. So we have to specifically, set up a separate account. The advisors know how to manage it. And then once the policy grows, then that assignment is released. And a lot of times these are accounts that the client's not, is using it for, savings and retirement. It's not like they need, that it's something they need in a year or something.
Yeah.
So, and then, real estate guys, are, notorious for, having a lot of assets and no cash flow, or, they're paying down debt or whatever. So we'll utilize their relationships with other banks that will provide a letter of credit for the collateral, saying that, Mike's good for this, and it's just a piece of paper. And then we're not tying up, because I don't want to tie up, capital for real estate guys, because they need it, for, how they earn a living. So, we have letters of credit, cash, investment accounts, other insurance policies that, have cash value in them. I have clients post that as the collateral. So,
Mhm.
lots of
Lots
different
of
options.
flexibility, but also with a strategic guide like yourself,
Yeah.
you're able to make sure that they are not going to lock up some asset that they're going to need access to, but still have that collateral there. So I just, everything that I'm hearing you say, it's like, it's a very meticulous, strategic way to set it up, plan for it, and review to make sure everything continues to perform the way that it is. So I think that is just a really spectacular overview here of some of those fears and risks. So if someone is interested in learning a little more and then also reaching out and connecting with you, Daniel, what's the best way that they can do that?
My website is www.perpetual, perpetualwm.com. So www.perpetualwm.com. There's an email, info@perpetual wealth. Phone number is on the website as well, 630-445-1399, 630-445-1399.
Perfect. Well, thank you so much for coming back on. It's been a real pleasure chatting with you again.
Thanks, Mike. I really appreciate it. So great questions, and I look forward to doing this again at some point in time. Thank you so much.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.